Hi, Steve Van Metre here, and welcome to Macro Wednesday, because I haven't thought of anything cool that goes with Wednesday and macro. Well, we answer your questions, try to make sense of markets that really don't make any sense, and more importantly, talk macro. Now, I want to go back to Monday's video where we talked about crude oil prices going negative. Now, obviously, you're following crude oil, you know that crude oil prices have gone up to somewhere around 13 to 14 a barrel, which is completely terrible for the U.S. energy sector, especially considering Saudi Arabia has 50.4 million barrels of oil on its way to U.S. ports that will be delivered next month. And sitting at sea is somewhere around 160 million barrels or some ridiculous number like that. This is bad news. And it's very deflationary. But I want to go back to that because I want to revisit what we learned from a macro perspective. Because what is macro? You know, if you're not sure what macro is, I live in California, so it's like me driving to New York. There's no way I can get there without consulting a map from time to time. I'm going to need it. And I want to make sure I'm going the right direction because there's sometimes the road's going to take me north or south or who knows where. And I still need to make sure, is this road going to take me east? Is it going to get me to New York? Micro is like driving home from work. I don't need a map. I could probably be blindfolded as long as someone told me approximately where I was. I could get home. And that's the difference. But we learned a lot on Monday, and it's telling us a lot of what's going to happen in the big picture. It doesn't tell us what's going to happen tomorrow or next week. It just tells us what is going to happen. So let's go through some charts and kind of revisit this. Because in the macro world, you always have to check your map. I don't have to worry about, what's going to happen on the way home. Maybe there's some road construction. I have to take a small detour. Big deal. But if there's some major problems on my road to New York, then maybe the problem isn't the road being out. Maybe things have changed and I need to change my view. So I always have to check in with my map, my investment thesis, to make sure I'm going the right direction. So let's do that. So one thing we learned was that crude oil prices lead the consumer price index lower. And since the Federal Reserve uses consumer prices as its target for inflation, this is really important. So we can see crude oil prices going down in every recession, and we can see that consumer prices have a larger reaction. Because crude oil is in so many things that we use in everyday life that consumer prices overreact to it. So now we know that crude oil is low. It's probably going lower, unfortunately. And consumer prices lag this. So in the months that come, so one of the reasons is I've said, I think my thesis plays out over the next 30 to 90 days is because there's a lag to the consumer price index. And the market doesn't believe that consumer prices are headed lower. They're going to head a lot lower, and it's going to take maybe a couple more months for the market to believe that. So we already know that crude oil is telling us consumer prices are headed lower, not higher. So the inflation theme that everyone's excited about is busted. Let's go to the next chart. This is real yields in blue. So what are real yields? Whenever you hear the term real, substitute it for inflation adjusted. And so we're taking 10-year Treasury yield, subtracting the year-over-year rate of the consumer price index, and now comparing it to the Wilshire 5000 or the stock market. And when real yields rise during recessions, we notice the stock market pukes. But that doesn't always happen. There are times that real yields rise and the stock market goes up. And based on what we know from crude oil, based on what we know what should happen to the consumer price index, real yields are set to go higher, and the stock market is not prepared for it. Everybody is extremely bullish still on stocks and not prepared for a major decline. They never really are. So let's carry this a little forward. Now, let's dump real yields and just look at inflation. Let's just straight look at consumer price index against the Wilshire 5000. And what you notice during recessions And during market drops, generally, consumer prices on a year-over-year basis decline. And all of a sudden, the stock market has a negative reaction. So usually a drop in consumer prices coincides, but not always, with the decline in stock prices. And you can see it in a couple different places here. And so now the question is, why? So when you get to a point you're not sure about, you should stop and act like a little kid. Why, Mom? Why, Dad? Why does this happen? So why is it the stock market doesn't like declining consumer prices? Well, it's real simple. We're in a debt-based economy where debt is prioritized. So let's take someone who has a mortgage. It's usually fixed rate. Some people have adjustable rate mortgages, but there's still a minimum payment they're going to be making. It's the interest that can adjust. So if consumer prices fall, what does that mean? It means demand is going down. Demand down, right? If I want to go buy a new car and the car I want is really popular, they're not going to give me a discount because they don't need to. Because they say, Steve, if you don't want to buy it at the price we're offering it for, it's okay. There's a line of people behind you that want it. Will you get out of the way now so we can sell it to someone who's willing to pay a premium for it? So when consumer prices fall, you're seeing them fall at the factory level, at the wholesale level, at the retail level. You're seeing it fall all the way across. And they're falling because people, or retailers, wholesalers, manufacturers need something. And what do they need during recessions? They need dollars, right? Think about it. If you've got this debt, right? What do you need? You need dollars to pay on that debt. And so to try to beat your competition, to try to get dollars from the fewer people that want to consume, you lower your prices. Pretty interesting, right? So that kind of validates what we see in this chart here, that falling consumer prices, which is deflationary, means asset prices go down. Shocking. Let's go forward. Now let's drop consumer prices and overlay crude oil. And look, because we know that crude oil is a big component in the consumer price index, indirectly. Energy is not the largest, but it filters into so many things. And look, when crude oil goes down, stocks tend to follow it lower, which I've shown in the past, just not using the Fed database. And right now, everyone is hoping crude prices are going to go higher, but reality is, and it's very difficult for all the people that I know that work in the energy sector, this is bad news. And it's going to filter through the rest of the economy, because unless demand all of a sudden comes flying back, crude oil prices are going lower. So what does this tell us? That we're in the right spot. Interest rates are going lower. We're going to see deflation. Stock prices are going to head lower. Crude oil prices are unfortunately going to head lower. It tells us we're in the right place from a macro investment. That is if you are aligned with my thinking. Of course, I don't obviously know how you're invested. I know how I am. I know how my clients are, and that's great. We're following our thesis that we're going to see deflation during this next recession, as we normally do. So it makes sense what we're seeing. Cool. So now let's jump into your questions. And I've got a ton of them. I want to get caught up on some of these. The first one, which I accidentally deleted last week. So to the person who sent me this, they said, how will we know that bond prices peak? Or I'm not sure if it was when interest rates bottom. The first time, how will we know? So if I'm not answering this correctly, please resend it to me and I will forward your question to the top of the list. There's lots of things I'm looking for. Speculators to be long. So right now they're net short treasury bonds. I'm looking for the dollar to go shooting straight higher and maybe start to peak. I'm going to look for stocks to crash, as you just saw. I'm going to look for yields to go negative on the short end of the curve. 3-year, 5-year, maybe 7-year. 10 years could be at zero or slightly negative. 30 years may not get to zero, but I think they're going to get really close. And I'm also going to look on a chart for bond prices to go just straight up like a rocket. That's what I'm going to look for. All right, next question. In your latest video, you said that fewer loans would cause interest rates to go down. That is correct. That's confusing me because if the supply of credit is lower, then the price of credit, aka interest rates, should go up. You said it goes down because of cherry picking. Can you give an example? Sure. Banks still need to make money. Financial conditions are tight and getting tighter. So let's just put ourselves, role reversal, right? Whenever I'm having trouble with a concept, it's like, let's put myself now as a role of a banker. So I'm a manager of, say a local commercial bank, and the big boss or a board member, somebody comes to me and say, hey, Steve, we still got to do some loans around here, and we've still got some money to lend. So I want you to go out and get your best clients and loan them some money. And we just need to be bringing money in, okay? Do not loan it to anyone that you think is not going to be able to pay it back. We have to get every penny of this back. We still need to bring some revenue in. So who am I going to call? All of the bank's best customers and biggest customers. The richest people the bank does business with. I'm going to call them all in and say, hey, guess what? Ladies and gentlemen, I have some money to lend, and I'd like to lend it to you. And even though financial conditions are bad and we're in the middle of a recession, I've gone to lend you some money. And what are they going to say? Yeah, I'm really not sure I want to borrow money at this time. And I'm going to say, well, I'm sure you all have some projects you want to do. Yeah, but Steve, while we may be independently rich and have businesses, this is just not the time to do it. And I say, look, why don't I just give you this cut rate interest rate? Oh, wait, how low? Did you just say that low? Yeah, that low. Okay, I'm interested at that price. I'll do it. And that's the key. If I invited those customers and said, hey, you know what? Things are really bad. I'm going to charge you triple the normal rate. They'd be like, see ya, out the door. I'm not coming back. In fact, I may move my accounts to another bank. So I have to lower my rates to entice them to borrow. That's how it works. All right, let's go on. Okay, the questions for this comes at the end. So the question is, what do you think? So I'm going to answer this kind of as we go through the question. I have a feeling that the dollar is about to dip and treasury bond prices will peak in May, June. I disagree with that. Signaling world dollar liquidity is restored. No. I don't think world dollar liquidity is going to even come close to being restored, because one of the tenets of world dollar liquidity is you need trade. So for world dollar liquidity to be restored, it means Americans are going out and buying foreign produced goods with borrowed money. I don't think that's going to happen that quick. And if it does, it needs to happen really quick, and it needs to be on a large scale. It can't be a small scale. It needs to be a big resumption of global trade. So no, I don't think that we're there. Not even close. Depends on the Fed's yield curve control introduction this time around. If they want to keep the longer duration bond yields low, such as mortgage rates tight as, then that would be good for bonds. So yeah, lower interest rates are obviously good for bonds. They're inverse. I don't think the Fed's going to have to target yields. I don't think they're going to have to suppress them, because when deflation, yields fall anyways. The Fed doesn't want lower interest rates. They don't want, I know it sounds like a dumb statement because they're lowering interest rate. I didn't say anything the Fed does makes any sense, okay? I never said that. They want higher interest rates in the end because that is a sign of inflation and a growing economy. They're lowering interest rates to get people to borrow. So there is a point where that will resume, but in deflation, interest rates go down. So I don't see that the Fed's going to have to control the yield curve to do that. But that would be good for bonds, yes, and gold. Not necessarily. If real yields go up, usually gold goes down. So I could be wrong, but that's just how it normally works. And bad for U.S. stocks, yes, as money will flow out of stocks / not get as much flow into stocks from excess reserves liquidity. Yeah, or here's a different way to look at it. In the midst of a dollar shortage, people need dollars. What do you do to get it? Sell things that give you dollars. So if you sell stocks, what do you get? Dollars. If you sell gold, what do you get? Dollars. If you sell oil, what do you get? Dollars. There you go. If you buy bonds and they go up in value and then you sell them, what do you get? More dollars. But if your stocks go down in value, you get less dollars. So people will tend to sell what's falling to get what they need. Let's go on. And the kind of the end of the question is, have to follow Australia and South Korea economies. South Korea, I would agree with that. I don't quite follows Australia that closely. But the second half of the question, I completely agree with. EM will recover faster like they did in the last recession. Absolutely. There's no question. EM, emerging markets, always does. So I agree with that. Next question. I don't get how I don't get how well can tumble oil. Okay. I don't get how oil can tumble 44% and yet oil's equities to oil stocks are not going down very fast. Take a look at Chevron and ExxonMobil. They do not seem to be a direct correlation. All right, so let's go to the charts and look. And the easiest way to do this is, where's my Exxon? Here's Chevron. And we will overlay the continuous contract of crude in purple. And let's zoom out. And yeah, equities don't always follow it lower. I mean, they will go lower. So we can see here, we can zoom in and see that Chevron stock is rising as crude oil is really not going up much. Probably the same for ExxonMobil. Yeah, we see the kind of the same. Exxon's trading a little bit differently, but you can notice that gold, or not gold, oil can go down a lot more than the stocks can go down. So they're not perfectly correlated at all. And here again, ExxonMobil stock is rising as crude oil is falling. So let's go back to the question, and there's not seemed to be a direct correlation. There isn't, because stocks are pricing in optimism. They're pricing in inflation. That's why. Another question, so this kind of, I paired these two together since they're both along the same lines. Do you see some of these large integrated oil companies like Chevron, ExxonMobil, so forth, cutting their dividends down the line? Yeah, I do. I'll tell you what I think is going to happen. We'll see if I get some emails from some of my oil clients that agree with this. So let's look at ExxonMobil. Same true for Chevron. You have a large topping pattern. So people that bought, when I say people, we're talking board members, executives, former executives, people that are billionaires, hundreds of millionaires, multi-millionaires, people with a lot of money and a lot of money in oil stocks. They were selling over the long process since 2006. You can say, well, looking at ExxonMobil. The notion that they've all bought back in here is unrealistic. What will have to happen is, in order for them to buy back in, they're going to have to tank the stock down to the point where no one wants to buy it. So oil prices falling is going to help that. The next thing that will happen is they will end up cutting the dividend, and people will go, oh my God, that's terrible. Because right now, if we go over and look at what ExxonMobil's dividend is, it's 8.25%. What's Chevron's? Wow, 6.1. So you go, man, 8.25%. That's pretty good. Yeah, and it's not going to hold because, again, if you are the market manipulator, if you are the one who wants to hold all these shares, you need to get them cheaper. You need to get it to the point where people don't want to buy them. Because if you've been selling over the process, now granted, they're going to be selling and rebuying some, but the long process of selling since 2006, then the prices on these oil company stocks are going to have to be depressed for many years for them to buy back in, which means they need to get everybody to sell. And how do you get people to sell when they're sitting on an 8.25% dividend right now? You cut the dividend down. You make this thing look so bad and so ugly, no one wants to own it. And then they will buy. And it'll be years before they come back. So if you're looking at the oil market, that's my opinion, you don't even need to worry about it for a while. Go find some other things to do to make money with, and then come back to this later. Because you want to just let all of these big money people buy up these shares, because at some point the stock will start going up, and then guess what they're going to do? They're going to raise the dividend back up because they want to get paid the dividend. A lot of these big oil investors, the executives, the board members, former executives, they live off the dividend. Yeah, so the price of the stock goes up. That's great. They're living on the dividend. So they need to make this thing really unattractive. And that's, I think you're going to see that go down. All right, thanks for posting your videos. I enjoy your format and the way you explain what also demonstrating through pulling up the graphs. Well, you're very, very welcome. Glad you enjoy them. My question is the following. This is a very interesting question. If you took Jerome Powell's job, who is the head of the Federal Reserve, as of today, 4/16, and you were told to keep the stock market, not necessarily the overall economy, propped up until early November. Obviously, that's going to coincide with the presidential election. What could you do? Another assumption that may be important is that Congress and the administration, including the U.S. Treasury, are willing to work with you on your decisions. Wow, I mean, that's kind of like saying everybody will do whatever you want, just keep stock prices up. I mean, this is a very interesting question. And I was kind of excited about answering it, but I didn't answer it right away because I had your other questions, plus I had to think about it. Also assume that you can let the economy crash right after early November, so right after the election, to allow it to correct itself. The reason I ask this is that while I'm bearish on the stock market, I want to understand what is within the powers of the Fed or government to keep things propped up. And the answer is, well, first, I wouldn't be stupid enough to take the job. But if I was forced into it, and I really wish I wouldn't have been, but if I did, there's really nothing I can do, because you have to look back at the last 10 years. What kept stock prices up? Corporate share buybacks. So in order for me to get the market up, I have to put a constant bid or a buy under the market. Now you can say, well, why wouldn't the Fed maybe get Congress to change the law and say buy stocks like Japan? Have you looked at a chart of Japan's market? I don't know if I have one handy. Let me see. It doesn't work. Oh, I do. Okay, so let's go and look at Japan, and we'll see maximum. No, this is not the full. It used to be way higher. This is just the ETF. So the answer is it doesn't work. And I don't think there's a way to do that at all. Now I'm going to give this question a second answer. There's another question that's going to ask a completely different question, but you're going to see the same answer to this of why there's no way I would do this. No way at all. No, I don't think there's any way that can keep them propped up. At all. Okay, where'd my questions go? But interesting. That was cool. That's a cool question. Here, the next question is, so let's tie these together. Thanks for answering my question. If you could also tell me your opinion on what the average time or how long do you think the deflationary period will transition to inflationary period, assuming the Feds don't implement any further monetary policy. Okay, well, the Feds are. So it doesn't matter. I'm going to show you why. You see how these two questions get merged together real quick. 2+ years. In the short term, it'll work. In the short term, there'll be an inflation scare. When interest rates bottom and the smart money starts dumping it, interest rates will go up. People will panic about inflation, and it'll probably roll over like we've seen it do in the past. And then it'll head lower. That's my expectation. It's going to take a couple of years. Now let me pull up. So you're going to, all right, this is my map of the Fed balance sheet, and I haven't updated it since the Fed went into crazy land of quantitative QE eternity. But this is showing a monetary lag of 18 months. So if we look at where we're at today, we're down here, and they're easy, more than I'm showing here. But what we're feeling based on an 18-month lag, where is it? April. So right now, if the lag between monetary policy and the real economy is 18 months, then we're about to start feeling the nuclear bombs of a 50 billion per month unwind of the Fed's balance sheet that started back in October 18. Now, I think we're actually closer to 2 years, and there's no easy way to calculate this. In fact, to my knowledge, there isn't a way to calculate it. It's people that have said 18 months have used some very good logic to say that, but the lag, it grows with the amount of government debt. So if we're closer to 2 years, which I think we could be, we're now just entering this 30 billion piece where we'll jump to 40 billion and then 50 billion. So what this is saying, and I've said this before, is when we get to the elections in November 2020, we're just going to have dealt that huge massive blow of all this monetary tightening. And if we're backed up here, it's going to be even worse. And this is one of the reasons why the Fed can't get out of its situations. It can ease and ease and ease, but it's stuck in these massive lags. It just can't get out of them. All right, let's go and hit, let's see, do I have time for another? Oh yeah, let's do this question. And then I want to look at a couple of charts, and then we'll try to get caught up on the questions on Friday, if not Monday. It says, I noticed the 10-year TIPS, Treasury inflation protected yields, move with the inverse of spot gold. Okay, well, let's go look at that because I've actually prepared a chart for that. Oh, whoops. There you go. You don't need to see that. Okay, there we go. So here is 10-year Treasury inflation index securities tips. So you said it runs inverse spot gold. All right, let's go gold. We'll add that. We'll send that over to the right side of this chart. And let's bring these together so we can see them. And it looks fairly inverse, but there's, oh wait, is that going to work? Okay, sometimes it doesn't always join them together, right? Let's inverse spot gold. And boom. Yeah, it looks pretty good to me. So yeah, I totally agree with that. Now let's go back to the question. You mentioned that we are in a disinflationary period as indicated by the CPI and crude oil prices. Yes. However, 10-year yield minus 10-year tips yield is moving up. I'm not familiar with that calculation, so if you could maybe send me why you were doing that. I didn't bother to do the formula, but I've never looked at it that way. So I'd be happy to learn something. If you could send me, why you're doing that math or some report on it, I would like to follow up on this question. Does this mean the tips are mispriced? No, not necessarily at all. And the Treasury inflation rate is wrong? Well, let's not say the Treasury's inflation rate. Let's just say the consumer price index is lagged. That's what you're seeing. The consumer price index is lagged. And therefore, gold should correct. That is my opinion exactly of what I think is going to happen. And then they follow up by, I've learned a lot since finding your page. Cool. Awesome. Glad to hear that. All right. We will get to the rest of the questions, hopefully by Friday, if not on Monday. Let's take a look at some charts real quick. Let's look at the S&P 500. Bounced off of support today, after crashing into support right here, where this little purple line is, bounced up, still below the 50-day moving average, usually a bearish sign. When we look at the weekly moving averages, when you start getting under the 50-day week or 50-week moving average in green, that's usually bad news. We've been under there for a while. And all we did today, for the most part, is we're kind of reconfirming the 100-week moving average. So it's acting like an area of resistance. So, kind of interesting that people wanted to bid stock prices up into tomorrow's not non-farm payroll, but unemployment report. But for some reason, Americans losing their job is bullish. Still working on figuring that out. So we noticed that yesterday, when we look at TLT, the inverse of pretty much 30-year yields, we noticed that it jumped over resistance in overnight trading, and then found sellers, in overnight trading, and found some sellers today until buyers came in. So from a charting pattern, we kind of broke out, looking like, hey, this thing's going to go up. And then sellers came in. The real key here is we're looking to see when sellers are exhausted, but you notice the sellers are running out of steam. They let the buyers get up to here, and they had to sell down back right under, for the most part, right underneath that resistance level, just hovering just right around 1.2% on the 30-year. We can see it on 30-year yields here. Here's roughly right, 1.2% right up here, but this is the main line at roughly 1.175. Still, sellers got yields up there. No chance that this lasts. I think the Fed's going to buy this down. CPI is going to show that real yields are going up and that interest rates are going much, much lower. Anyways, I'm Steve Van Metre. Really appreciate you taking the time to watch. We'll be back on Friday to kind of go into depth, look at that credit data, see where the markets are moving, and hopefully try to make some sense of it all. But somehow we probably won't. But anyways, thanks for watching. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This show is not to be construed as a recommendation or solicitation to buy or sell security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.